Hello, I'm John Persinos, editorial director of Investing Daily. Welcome to my latest video interview. Today, I'm questioning Jim Pearce, chief investment strategist of Mayhem Trader and our flagship publication, Personal Finance. How you doing, Jim?
I'm doing great, John. How are you?
I'm great. Thanks for asking. Jim began his career as a stockbroker in 1983, and over the years, he has managed client investment portfolios for major banks, brokerage firms, and investment advisors. In this video Q&A, I asked Jim several questions about the direction of the economy and markets in this time of COVID. You'll find his answers extremely useful as you try to navigate contradictory economic indicators and the emergence of the Delta virus variant. Jim, my first question. An increasing number of analysts are calling for a correction to occur by the end of this year. The potential triggers for a sell-off include a big spike in inflation, rising interest rates slowing global growth, an unforeseen international crisis, for instance, the collapse of Afghanistan, as we've just seen, and of course, a worsening pandemic. What's your view?
Thank you, John. My view is that stocks are priced for perfection, even though conditions are far from perfect at the moment. In addition to the factors you just mentioned, there's also the growing reality that next year's numbers won't compare as favorably as this year's numbers did. Last year was such an anomalous year with the pandemic. A lot of companies reported, a big jump in earnings, but the estimates I'm seeing for next year are maybe total per share earnings growth for the S&P 500 index of about 5% over this year. And yet, basically all of the major U.S. stock market indexes are at or near record highs. Um, I think that most of the pain from rising interest rates probably won't be felt until after next year's midterm elections. It's just a political reality. The Fed may start tapering before then, but I don't think it'll do so in a meaningful way until after those elections are out of the way. So, between now and then, I'm not expecting a stock market crash, but a decline of 10% could easily happen. And by the way, that's not the big deal that it used to be. When I started out as a stockbroker, gosh, nearly 40 years ago, a decline of 10% was a big deal. But the market's become more volatile and it's learned to live with that volatility. So we could easily have a decline of between 10 and 15, maybe 18%. And yet, as we saw last year, the market could recover from that within weeks or months. So, yes, I'm expecting a correction this year, but I don't necessarily think that that portends a reversal in the stock market or a crash.
Understood. One of the big macroeconomic debates right now is whether the rise of inflation is transitory or whether it will prove stickier. What's your outlook?
My outlook is some of both. The extreme, double-digit type of price hikes we saw, for example, in lumber earlier this year and with used cars, I believe that's transitory. But the overall cost of living is going up. So it'd be misleading to categorize all of the recent increase in inflation as being temporary. A lot of money has been injected into the economy to avoid a collapse, and the Fed won't be able to recover enough of it via quantitative tightening to prevent a long-term increase in inflation. Now, I'm talking years down the road, not the rest of this year or maybe even not next year. But I look for inflation to gather steam in 2023 once the Fed increases the rate at which it's tapering its bond purchases or discontinuing them altogether. At that point, any inflation that's still in the system can no longer be considered transitory.
Speaking of bonds, bond yields have been retreating in recent days. What is the bond market trying to tell us?
Well, normally declining bond yields suggest that slower economic growth is on the way. However, in this case, the decline in bond yields coincides with the rapidly escalating rise in new cases of COVID-19 due to the Delta variant. I don't think the economy will need to shut down again like it did last year. Half the nation is vaccinated. And we've all just learned how to live with it. We've all learned how to shop online. We've all learned how to work online. So if this fall, uh, social distancing restrictions are going to be, put back in place or even quarantining, there won't be nearly as much friction in the economy in terms of everyone adapting to that and being able to essentially carry on as close as possible to business as usual.
Under the conditions I've just described, which sectors look particularly appealing?
I like basic materials. That's the stuff that is used in building the products you and I buy. And the cost of sourcing the commodities to create those basic materials is relatively fixed, but the prices at which they're sold to manufacturers is variable. And like I said, I don't think all of this inflation is transitory. So I expect prices to continue going up, particularly with, in the job market now. It's a job seekers market, which means salaries will be going up, which means prices will be going up. So I like basic materials. I also think semiconductor chip manufacturers, especially those that own their own foundries, are going to enjoy growing demand for years to come, thanks to 5G and the Internet of Things. Just about any object we interact with on a regular basis will have a microchip in it to collect data and improve performance. And that's a trend. That's not just this year or next year thing. I see that for the remainder of this decade being a major growth driver for the economy. So those two in particular jump out at me as I think being good long-term sectors down really for the rest of this decade.
Okay, which sectors look particularly dangerous?
Well, in the near term, I think it's too soon to bottom fish and start buying up travel and tourism stocks until the Delta variant is brought under control. And it looks like it's going to get a lot worse before it gets better. And some of these companies are already in precarious financial conditions. A lot of them have had to restructure their balance sheets, issue a lot more debt, issue more equity, and they've got some tolerance for a little more pain, but not for a lot more financial damage if that occurs. I also think retail stocks are at risk of falling. First of all, they appear fully valued to me. The XRT, which is an exchange traded fund that owns over 100 retail stocks, is up 49% this year versus a 20% rise in the overall, the SPY, the S&P 500. So it's just going to be hard for them to continue performing at that level. And then we just saw earlier this week a survey from the University of Michigan where their consumer sentiment index took a huge plunge during the first 2 weeks of this month. Honestly, I don't know if that result is accurate or anomalous, but if it's even close to being a fair reflection of consumer confidence, then that's bad news for the retail sector too, because when people are feeling less confident, they pull in their horns, they spend a little less money. And so I just feel like retail stocks, through no fault of their own, are just fully valued and maybe at risk taking a little bit of a setback here if, in fact, consumer sentiment is declining.
Speaking of risks, what are some of the risks you think investors are underestimating?
Well, a lot of the risks that we've talked about, the situation in Afghanistan, the possibility of rising inflation, and so on, those are known, those are frequently discussed. And quite frankly, when one of them goes away, something else pops up. The market climbs a wall of worry, as we all know the old saying. I think what people are really underestimating is just the extent to which the stock market has become, in my opinion, overvalued and priced for perfection. And as an example, I like to look at the so-called Buffett indicator, which Warren Buffett was famous for, I guess, about 20 years ago, saying that he uses as a rough proxy for to the extent to which the stock market is accurately reflecting the economy. So essentially, it's a ratio of the U.S. stock market as measured by the Wilshire 5000 compared to gross domestic product in the United States. And right now, that ratio is higher than it's ever been. When I looked at it a few days ago, uh, the Wilshire 5000 was valued 2.4 times greater than U.S. GDP. Um, that's 90% above its long-term trend line. So granted, it's not a perfect indicator, but to me, that's a big red flag that people need to think about. The other thing in the near term that could kind of cause this house of cards to come tumbling down, even though I don't think the Delta variant of COVID is going to be as disruptive this fall as it was, say, last spring, it's a different situation overseas. And a lot of our manufacturers and retailers depend on suppliers overseas. And I feel like the supply chain could suffer another disruption later this fall. And that, it's not going to take a lot for people to decide, maybe we need to pull in our horns a little and, sell some stocks and just kind of sit tight. So to me, that's kind of the match that could spark the fire if we get another breakdown in the supply chain.
I see. Well, look, name an industry that stands out in your mind as a superb investment opportunity right now.
Well, I'll tell you, I don't normally use anecdotal events as the basis for an investment recommendation, but in this case, I just feel like the opportunity is too compelling to ignore. And this is based on my own personal experience. I'm at an age now, and I won't say how old I am, but like I said, started out as a stockbroker 40 years ago, so you can do the math. But I'm at that age where things like arthritis and just everyday aches and pains have become an annoyance. And I've tried a lot of the painkillers and topical creams, and quite frankly, none of them have really worked especially well. And I don't like the idea of just constantly taking painkillers and stuff like that. So a friend of mine convinced me to try some medical marijuana. And actually, when I say friend, it's actually a physical therapist that I've been going to. And I was skeptical, um, but I did it. And that was about 2 months ago. And I have to say, there's been a noticeable decrease in my overall pain level. I mean, it really does work, and it's not what people think it is. It's not a bunch of kids out behind the school getting high. It actually just looks like any other medicine that I use, but it works. And I'm a baby boomer, and I know that there's a lot of baby boomers out there like me who spent a lot of time of their youth out there being weekend warriors, and now they've got the aches and pains to show for it. I really believe this isn't just a trendy thing. Uh, in my opinion, I know it works, and I also know how big the numbers are when you start thinking about how much money is being spent on treatments and medications that really don't work that well compared to uh, what they could be doing with medical marijuana. So I'm really excited about that. And I feel like, again, as I was saying earlier, some of the other trends, I'm not talking about just for the next year or two. I'm talking about for this decade and really maybe the decade beyond. So I think that's a huge growth opportunity that right now a lot of people are overlooking.
Well, Jim, thanks for your time. That should do it for now. I really appreciate your superb analysis of recent stock market action and your outlook for the rest of 2021 and beyond. Thanks so much.
Well, thank you, John. It was good talking to you.
Absolutely. It's true. As Jim just explained, the legalization of marijuana is a social, political, and financial revolution that's making early investors rich. Pot sales aren't just surviving the pandemic, they're thriving because of it. As consumers clamor for cannabis to alleviate boredom, depression, and physical ailments, cannabis investments confer market beating potential, and they're a must for your portfolio. But the key is finding the right pot stocks. You need to conduct due diligence. We've done the homework for you. Our team has unearthed a hidden gem in cannabis business that most investors don't even know about. This trailblazing marijuana biotech is on the verge of becoming the Pfizer of pot. The time to act is now, before this little known company becomes a household name and its stock price goes ballistic. For details, consult my article that accompanies this video on the Investing Daily website. That's it for now. I'm John Persinos, and thanks for watching. Stay invested and please stay safe.